That in mind, Vivek, those are the index changes we have an eye on. Well, let's get back to the big story today. The Reserve Bank of India today announced an additional cash reserve ratio of 10% on incremental deposits that banks collected between the 19th of May to the 20th of July to neutralize the extra liquidity created by the return of the 2,000 rupee notes. And perhaps that's become one of the reasons why people have sold off bank stocks today. Latha is here to explain the announcement and potential implications. Latha, you've been speaking to a lot of bankers also on this. So what do you make of things?
Well, yeah, ICRR is incremental cash reserve ratio. Let's remember that cash reserve ratio is always a negative for banks. You collect deposits at whatever 8-9%, but you have to keep 4% of that, 4.5% of that idle. You're actually losing. But here, deposits, why have they done this? The total deposits in the system on May 19th, when the 2,000 rupee withdrawal was announced, was 183 lakh crore. And on July 28, it rose by nearly 10 trillion to 194.9 lakh crore. You rarely ever see in 2 months a 10 lakh, 11 lakh crore of deposit expansion. This is because everybody went and deposited their 2,000 rupee notes. But that is not the only reason. We will come to that. The point is to remove this liquidity impact. Already the vegetable prices are high, and to that you add more liquidity, more money chasing goods could make them expensive. So this is kind of an anti-inflation measure as well. You don't want too much liquidity lying around at a time like this. But the spurt in deposits, because of 2,000 rupee notes, is about 3.14 lakh crore. That's the amount of 3,000 rupee or 2,000 rupee notes that came back. Of that, 88% went straight away as deposits. That's 2.76 lakh crore. But look at the additional deposits. It is almost 11 lakh crore. That's because HDFC got merged with HDFC Bank starting from July 1st. That's what makes the number very big. So when the hit comes of keeping a little more money idle and not lending it, that is 10% of the extra deposits, HDFC Bank is likely to get a slightly bigger hit. Because if this measure had come before July 1st, they would have had to keep a little less. Now there is a big merger impact as well. And therefore, the hit is temporary. September 8th is when they are going to review it. Because September 15th, there is advance tax payment. So money goes out of the banking system to the government. September 28th, GST payment. Again, money goes out. September 19th is Ganesh Chaturthi. That is the start of the festival season. Huge purchases, that is cash withdrawals, are made. Deposits are withdrawn by people to make purchases. From September 19th onwards, then there is Dussehra in October and then Diwali in November. That is the big cash withdrawal period for the Indian banking system. So Reserve Bank appears to argue that by then liquidity will automatically lessen. So we need to take a call on September 8th whether we can end this cash reserve ratio, keep it only for 2 months. That's from May 19 to July 28. We will know on September 8th. Chances are they will remove it on that day. But nevertheless, for 2 months, banks are getting a punishment. One bank is getting a slightly bigger punishment.
Okay. All right, Latha, thank you very much for explaining that in a very nice, concise and simple manner for us to understand. And that also explains why bank stocks have not been really able to recover too much from the lows today. We'll take a quick break, come back. We're practically in the last leg of today's trading action. Get you all the details.